Hey warriors, I hope you're all doing well. So yes, tomorrow is finally your group 1 completion last paper, your direct taxes. I wanted to quickly come forward today and post a very small video where we are going to be discussing of some top 30 tricky adjustments for you to prepare for your exams. You may have already seen the video on Super 50 adjustments and the capital gains decoding which we have put in the morning. This video is going to give you a quick revision of 30 trickiest adjustments which ICA has asked in the past and what you should be doing in those kind of adjustments. Please look at this video after you have completed your first preparation of your direct taxes so that you can quickly link on this. If you're able to answer these adjustments, then yes, you have done a very nice preparations. If not, no worries. Now that you know these adjustments, you'll be better prepared for your exams off. So without wasting any further time, we're going to quickly look into this 30 adjustments. See if you're able to answer it from your side first before you take the answer from my side. Yes, so I'll be reading out an adjustment. You will take a pause, you will understand the adjustment from your side, match the answer from your side, and if it matches, amazing. If it doesn't, then you can note down the same adjustments accordingly. Shall we go forward? Awesome. Let's take it forward from here. Tricky adjustment number one. The question would give you an MCQ kind of format. The question says, I have a salary given to you of 2,60,000. I have an LTCG under 112A given to you for 3,50,000. Winnings of 40,000. Total chapter 6 reductions after considering everything has been given as 3 lakh rupees. They're asking you to compute the tax liability. Assuming I'm going for old tax regime. Yes, assuming I'm going for old tax regime, this is what the question should be. Now, how do I answer these kind of questions? First of all, people, you need to keep this in mind. When it comes to Chapter 6 reductions, a Chapter 6 reduction can only be set off against what? It can only be set off against your slab incomes. You cannot set off against any of the LTCG or winnings, which means 3 lakhs will get restricted to 2,60,000, and that is what you can adjust off. Which means my salary now is going to be reported as 0. My winnings is going to remain at 40,000 rupees, and my 112A gets reported as 3,50,000. Yes, this is how I will report my total income, which means my total income will be reported as what? It will be reported as 3,90,000. Are we clear till here? Yes. So what are we doing, people? First thing, when it comes to Chapter 6A, Chapter 6A can only be adjusted against slab rate incomes. So I adjusted it against a salary. Balance, I will not be able to adjust off, so that gets wasted off. So which means now my total income becomes 3,90,000, on which I have to now compute tax. Adjustment number two. The trickiest part which comes in adjustment number two is when you don't utilize your slab completely, you're eligible to utilize your capital gains for the purpose of slabs. You cannot utilize your winnings for the purpose of slabs. You can utilize your capital gains for the purpose of slab. So which means out of 112A, I will be sending across a little bit of the income to my slab. And therefore my slab income will now become 2,50,000 rupees, which will be liable for no tax. Yes, tax on this will become 0. I hope everyone is able to follow this part. Yes, so what did I do? I took my 112A, I adjusted it to my slab income, and therefore my slab became 2,50,000. Tax on that becomes 0. Then I go to winnings. Winnings will remain as it is. Can you utilize winnings first for the purpose of slab? No. So 40,000 into 30 percentage will be become 12,000 rupees. Yes, so 12,000 rupees will become fully taxable for winnings part. And when it comes to 112A, what did I do, people? I took 3,50,000, 3,50,000, 1 lakh, 2,50,000 went off to my slab, which means I am left with only 1 lakh rupee. That 1 lakh rupee will not be liable for any tax because because it is less than 1,25,000 current year amendment. It is less than 1,25,000 current year amendment. Therefore, nothing will be liable. So 12,000 rupees is what is left in my hand. This 12,000 rupees, people, I will be eligible for something called as rebate. Yes, I will be eligible for something called as rebate, and therefore my tax liability becomes 0. I will not have any tax liability because I am eligible for rebate up to 12,500 rupees. 12,000 is all my tax liabilities, and therefore the number becomes 0. A very good question, people. Three things to be kept in mind. When it comes to Chapter 6A, you can only adjust against slab rate incomes. When it comes to slab having no utilization in the basic exemption limit, then I can use my capital gains for adjustment. And then because my total income was less than 5 lakhs, I'm eligible for rebate off. Yes, very good. Next question says dividend is received from a foreign company which derives its value substantially from its Indian assets. This was a question which came up in your May 2025 examinations. Question came is when a dividend is received from a foreign company, is it taxable in India? Is it taxable in India? The answer is no. You will not be taxable for this in India because only dividend from an Indian company is taxable in India. What happens to this word, people, which says it is deriving its value substantially from assets located in India? Is that of any relevance? No, it is of no relevance. This point has no relevance at all. You will ignore this point. It doesn't matter. The question mark should be you should be able to have something called as an Indian company here. There is no Indian company. It is not taxable. Third, when it comes to interest paid by an NR to another NR for purchase of shares in India to earn dividends. People, when it comes to NR to NR, normally what happens? Questions come and say that when an NR is giving money to an NR, it is taxable in India for three components: interest, royalty, and FTS. All the three components are taxable in India if the business or profession or the other sources income is generated in India. Only one exception is there, which is interest. In interest, it comes and says when an NR is paying to an NR for interest income, which is going to be utilized for other reasons in India, it is not taxable, which means this will become not taxable. Had this question not been interest, had it been royalty, had it been FTS, I would have said fully taxable. I would have said fully taxable, but because this is interest, I would say it is not taxable. Yes, we did this in the class many times, people. I hope you are able to recollect this. Next, any kind of salary allowance or perquisites which is paid by an Indian government to a foreign citizen outside India. Yes. Now, normally you would have learned this provision, people, which comes and says when a salary is paid by a government of India to a person outside India, it is fully taxable as it is deemed to accrue or rise in India. However, allowance and perquisite is fully exempt. That is what you would have learnt. Yes. But what students end up making a mistake upon is people that provision is only applicable in case you are an Indian citizen. Here is a case where the person is a foreign citizen. A foreign citizen is not covered in that exceptional rule, which means a foreign citizen will not be deemed to accrue or rise in India. This also becomes not taxable for all the three components. Salary also will not be taxable. FTS, allowance is also not taxable, and perquisite is also not taxable because it's a non-resident receiving money outside India, has nothing to do with India, even if the payment is made by Indian government. Indian government payment will only be taxable if it was an Indian citizen. Yes or no? Yes, let's keep that in mind. Five, laptops given to brother of employees for personal use. People salaries chapter, you would have got a question in exam which says an employee's brother has received a laptop from the company for personal usage. Is it gonna be taxable? Answer is no. Yes, income tax comes and says laptops given to employees are fully exempted whether it is for business or personal use. It does not matter. Fully exempted. Next, medical insurance premium or life insurance premium is given to employees by the employer. If employer is giving life insurance premium, life insurance is fully taxable. Life insurance is fully taxable. Medical insurance becomes fully exempt. Yes, that is what we would have learned, people, when it comes to medical items. In medical items, you would have learned it is insurance of health which is fully exempted. Insurance of life is fully taxable. Yes, when it comes to professional tax paid by employer or employee, this is what you have to keep in mind. When it comes to professional tax, people, if the payment is happening by employer, first it is added as perk and then allowed as section 16 deduction. Section 16 deduction. If it is an employee, it was never a perk. It is directly allowed as Section 16 deduction. This is what the concept is. Yes, so when it comes to professional tax, employer paid professional tax added as perquisite claimed as deduction. Employee paid perquisite directly claimed as deduction. But notice carefully, these items are only applicable if you are opting for old tax regime. Yes, so if you're opting for new tax regime, you will not be eligible for the deduction, which means if you're opting for new tax regime, only add to perquisite an employer contribution, forget of the employees component, has nothing to do with the provision at all. Which means what will you do, people? If I come and give you a question that this is old tax regime, this is what the rule is. Imagine if I tell you what happens in new tax regime, you will simply add the first component as perk, no deduction here, and similarly when it comes to employee, no deduction here. That is what the provisions would be. Are we clear? Yes, amazing. Moving on to HP chapter, people. Imagine if you get a question like this which says Mr. A is occupying ground floor for business and first floor is SOP. Notice first floor is SOP, which means this goes into HP chapter. Yes, this goes into HP chapter, whereas the ground floor is used for business, which means this goes into PGBP. Yes, this is the kind of question which has become very famous off late by ICI. I've seen it in the last three attempts together. So these kind of questions you have to be very careful. What you're going to do, people, now is that all the expenses components which you have, you're going to take all the components and split them into PGBP and HP. Whichever can be claimed in HP, you'll claim it in HP. Whichever can be claimed in PGBP, you can claim it in PGBP. Yes. So what are you going to do when it comes to municipal tax of 20,000? Let me split off and tell you. If I show two components, one is called PGBP, one is called HP. One is called PGBP, one is called HP. Municipal tax 20,000 rupees split into two. So 10,000 goes for HP, 10,000 goes for PGBP. 10,000 in PGBP fully allowed as deduction because it is a business expense. But because it is an SOP property, cannot claim municipal tax. Yes or no? Similarly, when it comes to repairs, nothing can be claimed under HP because there is no concept to claim repairs under HP. But the 5,000 can be claimed under PGBP. Renovation becomes the same. I will get 2500 under PGBP, nothing will come under HP. Insurance again, nothing will come under HP, 5000 will come under PGBP. That is what you would have done. When it comes to interest on loan, what will you do? Split the interest on loan into two again, people. 4 lakh 50 is there, split into two becomes 2 lakh 25,000 and 2 lakh 25,000. Full 2 lakh 25,000 allowed under PGBP chapter, allowed under PGBP chapter, but because I am in HP chapter and the property is an SOP property, you can only claim maximum 2 lakh rupees. You can only claim maximum 2 lakh rupees. Yes. So this is what you will do when it comes to these kind of questions. Always ensure that when you get a question like this, where there is part SOP, part LOP, or something is going to PGBP, something is going to IFOS, there is no restriction in PGBP and IFOS. The provisions remain the same. You can take it as it is. All expenses allowed as deduction. Whereas when it comes to HP chapter, you can only claim municipal taxes if it is LOP property, interest on loan if both the properties, and then 30% deduction if it is an LOP property. This is how you'll have to split this accordingly. Are we making sense? Perfect. Great. We're moving on to question number 9. It says Mr. A is a real estate dealer and has let out his residential or commercial unit for a rent of 50,000 rupees per month. People, look at my job. I am a real estate developer. As a real estate developer, people, my job is to buy and sell properties. When I'm buying and selling properties, letting out a property is not part of my business, which means this is fully taxable under HP. Yes or no? Yes, whether you call it residential property or you call it commercial property, I am not in the business of letting out, and therefore this is taxable under HP. Whereas if it is Mr. A in the business of letting out residential units or commercial units, if you are in the business of renting out of residential units or commercial units, then in that case, what happens, people? If I'm in the business of letting out residential unit, current year amendment comes and clarifies this is also going under HP chapter. Even if you are in the business of letting out, it is taxable under HP chapter. But if you are a commercial guy, then it is going to go under PGBP. Yes or no? Yes, that is what is the amendment of current year, people. Letting out of residential units taxable under HP, but letting out of commercial units is taxable under PGBP. Keep that in mind. Next, when it comes to Mr. A taking a loan on 1st August 2021 for purchasing house property is completed only on 31st March 2025. Yes, there is a pre-construction interest question. This pre-construction interest question, like what will you do? You'll come and say from the date on which the loan was taken up to year prior to the year in which the house is completed. People, when is my house completed? My house is completed on 31st March 25, which means 24-25 will become current year. Rahul, it is the last day. It doesn't matter. It doesn't matter. Even if it is the last day, this year will be fully considered as current year, which means up to 31st March 24, whatever you have incurred will be called as pre-construction interest. In which case, in my question, if the pre-construction interest up to 31st March 24 is given as 5 lakh rupees, I will take this 5 lakhs and divide it by 5. I will allow 1 lakh rupee every year. Yes, on the contrary, the 2 lakh rupees will be fully allowed as deduction in the current year itself, which means I can claim 2 lakh of current year interest plus 1 lakh of pre-construction interest. Totally, I am eligible for 3 lakh rupees. With this 3 lakh rupees, I'll ask a simple question. Is the property an LOP property or the property an SOP property? If the property is an LOP property, I can claim the full 3 lakh rupees as a deduction. But if the property is SOP property, I will restrict this off to 2 lakh rupees. Yes or no? Yes or no? That is what you'll do, people, when it comes to pre-construction interest. Very good. Question says, Mr. A is receiving 40 lakh rupees as rent during the year, out of which 30 lakh rupees relates to HP and 10 lakh rupees relates to amenities. This is the concept of composite rent. Composite rent comes and says when you're receiving rent consolidated for house and something else separately, then the HP part will go under house property. This will be taxable under HP, whereas this will be taxable under IFOS. Will be taxable under IFOS. You cannot tax everything under HP, people. You'll have to tax it as HP for 30 lakhs and 10 lakhs for IFOS. Keep that in mind. Yes, next, the very important part on 13, people, which says if your rent receivable is 20,000 rupees per month and the GAV is given as 2,50,000, vacancy period is 3 months. Question says per month I would have received a rent of 20,000. Yes, my GAV has come to 2,50,000, which means if you check on an yearly basis, I would have paid 2,40,000 to government. If you check on this carefully, my actual rent has come to 2,40,000. Had I not had any vacancy, my actual rent would have come to 2,40,000. Whereas my, sorry, not GAV, this is expected rent. My expected rent is 2,50,000. My expected rent is 2,50,000, whichever is higher, which means my GAV has come to 2,50,000. Check and tell me, people, if my GAV is 2,50,000, I am already reporting a rent less than what government expected from me. Can I claim any vacancy loss? No. No vacancy loss will be allowed to you in this question. Yes, what is the provision? The provision comes and says you can arrive and claim vacancy loss from your actual rent, provided actual rent was determined as your GAV. Since in this case my GAV is going to be based on expected rent, no vacancy loss can be granted to me. I will not be allowed for the vacancy loss. Yes, very good. Next, we have unrealized rent received in the year in which HP is sold. In the current year, I don't have a house property, but I've received unrealized rent of the past years. Under which head will it be taxable? It will be taxable under HP. How much will be taxable? You cannot tax the full 80,000 people. It is 80,000 after allowing 30% standard deduction. So 80,000 minus 30% deduction gives me 56,000. Gives me 56,000. Only 56,000 will become taxable for you. This is an MCQ level question. So keep that MCQ question in mind. Yes. Moving on to PGBP, last 15 adjustments. Stay with me, people. Stay with me. We are at question number 15. It says contribution to IIT for 5 lakh rupees, which is used by them for buying a land. Scientific research rules come and say that in-house, when you are going to incur any expenditure, you can incur any expenditure for anything except for land. Here is a case where I'm not doing in-house expenditure. I'm actually contributing to a third party. When I'm contributing to third party, I am fully eligible for deduction. It does not matter what that person does. That person may buy it as a land or he may use it for other purposes. It does not matter. I am allowed a deduction because from my side I gave a donation. From my side I gave a donation. It does not really matter. But notice, people, this is only applicable under OTR, only eligible under old tax regime. I cannot claim it under new tax regime because in new tax regime you are anyway not allowed for any donations as a deduction. Yes, so if it is a new tax regime, I would disallow this expense. But if it's an old tax regime, I can claim this expense as deduction even though the other person is buying a land with it. I don't care. Enika Puerto Rico, I have used it for donation purposes. It is fully allowed as deduction. Had I done an in-house expense where I had bought a land, I would have not allowed it as a deduction. Yes or no? Yes. 16, the something which gets tested in exam very oftenly, people. It says employer contribution of 3 lakhs for March 25 is deposited in May 25, and employee contribution of 3 lakhs for March 25 is deposited in May 25. Notice the first one is employer, the second one is employee. What is the difference, people? When it comes to employer contribution, you can pay it up to due date of return filing, which means you had time until October 25. I have made the deposit by May 25 itself, which means no implications here, fully allowed as deduction. So I have no restriction here. This is allowed as deduction, no implications on this part. Whereas when it comes to employees contribution, I have a restriction of making the payment by the 15th of next month. Yes, so I should have made the payment for the month of March by 15th April itself. By 15th April itself, I have made the payment in May, which means I've done a delay. Because I've done a delay, this will be treated as income. This will be treated as income. Are we clear? Yes, great. Question number 17 says interest on loan has been taken on car for 1st April 24. Car has been put to use on 1st October 24. Notice carefully, this was taken on 1st April, whereas the car is put to use only on 1st October. Here comes your borrowing cost standards. Borrowing cost comes and says interest on any asset will be capitalized until the asset is put to use. My put to use happened only in October, which means whatever interest I incurred from April, May, June, July, August, September will get fully capitalized. Yes, so what am I going to do? 12 lakh is my interest for the full year out, which means 1 lakh is the interest per month. So April, May, June, July, August, September, I will have 6 months. So what will I do? 6 months will get capitalized. In simple words, 6 lakhs I will capitalize and balance 6 lakhs will be allowed as deduction. Yes, so 6 lakhs I will capitalize, 6 lakhs allowed in P&L. Yes or no? This is what is the provision of borrowing cost. I hope everyone is clear on this part. Clear? Yes, amazing. Next comes to employer's contribution to NPS at 16% is 1,60,000. Current year amendment, people, income tax comes and clarifies in the current year an employer cannot contribute more than 14%. Because the employer has contributed 16%, I will try to find out how much would it be 14%. If 16% is 1,60,000, 14% would be 1,40,000. Because I've contributed more than 1,40,000, I will disallow 20,000 rupees. I will disallow 20,000 rupees. Yes or no? Yes, amazing. Then we have penalty paid to government for violating terms of contract. Notice I am going to violate penalty for a contract. Income tax 37 says you can only disallow when it is violation of a law. Because this is violation of a contract, I have no implications here. This is fully allowed as deduction. It is fully allowed as deduction. Amazing. Then we have amount to be paid to medium enterprise 5 lakh rupees on 14th March 25, which was paid on 10th April 25. Medium enterprise, I was supposed to pay the payment by 14th March 25, but I made the payment on 10th April 25. Do I have a problem? No problem. People understand the provision which was introduced was only for micro and small enterprise. Medium enterprise has not been implicated, and therefore this is allowed as deduction. Even though there is a delay, it does not matter. It does not matter. It is fully allowed as deduction. However, it says interest is accrued on the payment of 20,000 rupees. People, interest on MSME is fully disallowed. Now, one thing which students have to keep in mind is when it comes to 43B, when it comes to the payment model, micro and small are ones which are considered. But when it comes to interest, micro, small, and medium, all the three are disallowable. All the three are disallowable. You have to keep that in mind. Yes or no? Yes. So please be careful, people. When it comes to payments, it is micro and small enterprise. But when it comes to interest, it is all the three. So therefore, because it was medium enterprise, payment got allowed even though it was delayed, but interest got disallowed because that is not permitted. That is not permitted. Clear? Yes, amazing. Section 21, where in IFOS, people, IFOS dividend earned is saying 3 lakh rupees, interest incurred is 70,000 rupees. Dividend rule comes and says when you have incurred any interest for the purpose of dividend, you can only claim up to 20 percentage of the dividend income. So 3 lakhs into 20 percentage gives me 60,000 rupees. I have incurred 70,000 rupees. Can I claim 70? No, can't claim 70, which means my interest, my dividend income will become 3 lakh minus only 20 percentage reduction, which is 60,000. Therefore, 2 lakh 40 will be my dividend income. 2 lakh 40 will be my dividend income. Very good. Yes, then we have A Limited has bought back shares of Mr. X at 8 lakh rupees when the accumulated profit is only 1 lakh rupee. Mr. X is purchasing the shares for 5 lakh rupees. People, buyback dividend, current year amendment comes and clarifies that when it comes to buyback dividend, whatever money you have received will be fully taxable as IFOS, will be fully taxable as IFOS dividends. Yes, so full taxability of IFOS dividends of the 8 lakh rupees. The accumulated profit does not matter. I am not bothered about the accumulated profit. It does not matter. The cost of acquisition, which is there for Mr. X, will be treated as a capital loss, will be treated as a capital loss. Yes. So what will you be doing in this provision, people? You will say that the money received will be taxable as buyback dividends, and whatever cost of acquisition was incurred will be treated as a capital loss to be carried forward for a period of 8 years. Yes. Very good. 23, a very very good adjustment and something which has been tested in exam so many times right now. Clubbing of income question, people, look at this carefully. It says Mr. A is transferring his house property to his minor child. Child has earned a rent of 1 lakh rupees per month. Mrs. A is the parent with the higher income. Now, normally what students end up doing is they come and say, yes, clubbing rules will apply. Clubbing rule comes and says, tax it in the hands of the parent whose income is higher and grant a 1,500 rupees ka exemption. Which means in this case, normally students would come and say, the rent which is received by the child will be fully taxable in the hands of Mrs. A because her income is higher. Unfortunately, this is wrong. Unfortunately, this is wrong. Notice carefully, people, this is an house property. Yes, now when it comes to house property, before clubbing applies, there is a section called section number 27. There is a section called section number 27 which talks about deemed ownership, people, and deemed ownership comes and says when any parent is transferring anything to his minor child, that respective parent is who is taxable under the head HP. Yes or no? Yes, I'm repeating myself once again. When a parent transfers some things to his minor child, that parent is taxable under the head HP, which means in this case, because Mr. A gave it to his minor child, Mr. A is the one who's going to be taxing on the income. It is going to be Mr. A, and Mr. A will be taxing this whole income, which is 1 lakh rupee into 12 months, which is 12 lakh rupees. But because this is house property, I can claim a 30 percentage reduction. Number becomes 8 lakh 40,000. Number becomes 8 lakh 40,000. Now comes the question, Rahul, because this is minor child's income getting taxed for Mr. A, can you be allowing a 1,500 standard deduction? No, no exemption will be granted to you people for clubbing rules because I did not even applied clubbing. I did not even apply clubbing. What did I apply? I applied deemed ownership rules. Here, I ended up applying section 27 rules. I did not apply section 64 rules, which means I cannot give 1,500 deduction. I cannot give 1500 deduction. That is not allowed. Yes, this is a very, very tricky part, people, which has come in exam multiple times. Understand, any kind of transfer happening from a spouse to his spouse, or transfer from his spouse from a parent to his minor child for a house property, goes under deemed ownership rules. It does not go under clubbing rules, and therefore clubbing provisions will not apply. HP rules will apply. Because clubbing rules itself are not applicable, no exemption of 1500 rupees will be granted to you. Yes, amazing. 24. It says loss from FNO. This is something which came in May 2025 exams, people. ICI has taken a position saying loss from FNO is a normal business loss. Loss from F&O is a normal business loss. It is not going to be treated as a speculative loss. Because it is not treated as a speculative loss and it's a normal loss, you can set off against any head other than salaries. Yes, so be very careful on that part of it. Next, salary received by a partner from a partnership firm. People, salary received by a partner from a partnership firm will be what? It is going to be taxable under PGBP. Yes, a salary received by a partner from a partnership firm is going to be taxable under PGBP. The firm could only claim 3 lakh rupees as a deduction. Here is the catch point. Understand, when it comes to PGBP chapter comes and says a partner is taxable only to the extent it is allowed in the hands of the firm. Again, a partner is taxable only to the extent it is allowed in the hands of the firm. The firm only allowed 3 lakh rupees, which means the partner cannot be taxed for 5 lakh rupees. Partner will come and say, I'm sorry, I am exempted for 5 lakh rupees. What I am taxable is only 3 lakh rupees. What I'm taxable is only 3 lakh rupees. Similarly, people, if it says interest on capital received is 14 percentage and is 1 lakh 40,000. 1 lakh 40,000 is the interest on capital received at 14 percentage. PGBP rules come and say that the firm can only claim a deduction up to 12 percentage, which means a partner is also taxable only to the extent of 12 percentage. Partner will come and say, I'm sorry, 1 lakh 40,000 is what I received, but in that 1 lakh 40,000, the firm is only allowed a deduction of 1 lakh 20, so I am also taxable only for 1 lakh 20,000. I'm also taxable only for 1,20,000. This is something which is very, very commonly tested nowadays when it comes to clubbing and set off chapter. So please be very careful on this. Yes. So what is the rule, people? When it comes to firms, whatever is deduction for the firm is the taxable amount for the partner, because it is deducted only to the extent of 1,20,000 for interest and 3 lakh for the salary. That is what a partner will also be taxable. Everything else will be exempted in the hands of partners. Yes, last four adjustments. Speculative profit is 5 lakh, business loss is 4 lakhs. Question is, can you set off? Can you set off business loss against speculative profit? Answer is yes. Restriction is only from speculative loss to business profit. No restriction from business loss to speculative profit. Completely permitted. 27. HP loss is 4 lakhs. What are the tax treatment under both the regimes? People, when it comes to HP loss, the things which you have to keep in mind is, if you are going for old tax regime, if you're going for old tax regime, you can set off against HP income. If you're not able to set off against HP income, you can set off against other heads up to 2 lakhs. If that also you cannot do, you can carry forward for 8 years. Yes, so when it comes to old regime, what are the rules, people? You can set off against HP income. If you're not able to set off, you can set off against other heads up to 2 lakh rupees. If you're not able to do that, you can carry forward for 8 years. But when it comes to new tax regime, if it is default tax regime, you can only set off against HP income. You can only set off against HP income. No carry forward, no other head adjustments. Directly set off only against HP income. If you're not able to set off, it is permanently gone. It is permanently gone. Yes, yes, yes. Amazing. When it comes to question number 28, talks about NPS contribution. What is NPS contribution, people? Income tax says when it comes to NPS contribution, two people can contribute. One is employer and one is employee. Yes, if an employer is contributing, first thing you will add it as salaries. First thing, you will add it as salaries, and then you will allow a deduction under 80 CCD. You will allow a deduction under 80 CCD. How much can you claim, people? Under 80 CCD, you can allow up to 10 percentage of salary if you are under old tax regime, and you can allow 14 percentage of salary if you are under default tax regime. Yes, that is what the rules are. What are the rules? If you are under old tax regime, you can claim up to 12 percentage of salary, but if you are under new tax regime, you can claim up to 14 percentage of salary. If it is employees contribution, people, what will you do? For the first 50,000, there is no restriction. For the first 50,000, there is no restriction. For the balance, you can claim up to 10 percentage of your salary. Yes, that is what we would have discussed of. What is the provision once again, people? Two people can contribute, one is employer, one is employee. Employer contribute panna first added as salary, and then you can claim chapter 6 a reduction up to 10 percentage of salary under old tax regime and 14 percentage of salary under new tax regime. If you are under employees contribution, first 50,000 flat deduction, no restriction, balance will be allowed for 10 percentage of salary. Right side is only applicable if you are under old tax regime. Right side is applicable if you're under old tax regime. Yes or no? Yes, amazing. Last two. It says Mr. A is age 65 years and has taken a medical insurance of 26,000 and has incurred a medical expense of 28,000. What is the deduction under ATD? Couple of things to be kept in mind. First, because the person is a senior citizen, I can claim a deduction up to 50,000 rupees. Yes or no? Yes. But here is the problem. I have taken an insurance, I have taken an expense. Which one can I claim? I can only claim my insurance. Understand, people? Medical expense as a deduction can only be granted when the person has no insurance, which means if you don't have any insurance from day one, then only you can claim a medical expense. In this case, because I already have an insurance, can I claim a medical expense? No. I cannot claim my medical expense. The 26,000 is what I'll be allowed as a full deduction. I'll be allowed as a full deduction. Yes or no? Yes, amazing. And that brings me to the last one, people, which is called post office savings. Income taxes, when it comes to post office savings, couple of things you need to do. First, when it comes to post office savings, you'll add it under IFOS. Second, under the same IFOS, you'll be claiming a deduction of rupees 3,500. Third, you can end up claiming something called as a Chapter 6A deduction for Section 80 TTA if you are a normal person for 10,000 rupees, or 80 TTB if you are a senior citizen for 50,000 rupees. If you're a senior citizen for 50,000 rupees, this is what you're going to claim as a deduction of. Yes, so this is what you're going to do. Are we making sense? Perfect. People, this is your top 30 adjustments which I wanted to check with you. If you have got many of the adjustments right, then amazing work. You're already prepared for your exams for tomorrow. You're going to have an amazing time tomorrow. If you have been making mistakes, no worries. I hope by now you would have realized what kind of mistakes you're making and you've already started marking those off. Please keep those in mind before you go for your exams tomorrow. Tomorrow, quickly before your exams, we'll be giving a very short video on the theory questions you can expect for your exams. You can go through that also and prepare for your exams very well. But yes, I'm going to stop the video. I'm not going to waste any more time. All the very best for your examinations for tomorrow. You people are going to do an amazing job. Especially after the news that law paper was extremely difficult. I have a gut feeling that the tax paper should be a lot more manageable for you. So yes, you should be able to do really well for the papers. I hope to look forward to see all your feedbacks after the exams. But yes, do all that if you are done with your group 1 exams and are not planning for group 2. If you're planning for group 2 exams, continue with your group 2 preparations, and then after that you can come back and give me your feedbacks. Your review of your papers will be given to you as soon as all the papers of group 2 are also getting over. So we'll be discussing it then and there. But yes, all those are very early for me to discuss right now. Right now you are at the phase where you are already ready to complete your CA inter with flying colors. So please take this opportunity and do your best in the next exam. I know it's going to be amazing. Until then, take care. Bye bye.